Let's bring in Steve.
Bring him in.
Aforementioned.
Yes, the aforementioned Steve. CNBC senior economics reporter Steve Leisman. Steve, I'll ask you that question. You were sitting, you opened up the press conference with Chair Powell. What does 3.477% on the 10-year yield tell you? The fact that yields went lower today.
I don't know what to believe anymore, Melissa. I am betwixt and between. I'm about to have a intellectual crisis right here on national television. I have a Fed chair and a really committed Federal Reserve to raising rates above 5%. And I have a market, for lack of a better word, showing the Fed the finger, essentially, here. And you can see it. Can I say that on national television? I don't even know.
Did, sir.
I just did.
You just did.
But I didn't say the word, so maybe that's okay.
It's fine.
It was right. It's fine. So anyway, the point being that when you look at, guys, if you could put up that Fed rate outlook chart, look at where the market is for next year. That gap is now growing, which is now grown today from where the Fed thinks it's going to be and where the market thinks you're going to be. So what is that? 65 and 15. That's 80 basis points right now between where the market thinks the Fed's going to be end of the year and where the Fed thinks it's going to be. And if you're going to ask me, who do you believe? I don't know. I don't know. The market has a view. And I got to say, the only way to square this, the market view, is that inflation comes down, and it comes down hard and fast and convincingly. If that is the case, the market will be right and the Fed will be wrong. I think there's less consequence to the Fed being wrong than the market being wrong, because if the market's wrong and inflation stays high and the Fed has to go up to 5 and change, I think there's some adjustment in some of your guys' portfolios over there that needs to be done.
Yeah. I mean, if inflation comes down very swiftly, which would be a great thing, there's still a lot of tightening, the lag effect that's going to happen, and there's the QT effect that's yet to happen. And so,
that's right.
I think that people on this desk might posit that 3.477 is telling you that the Fed has overstepped or will be in a position where it has overstepped, because inflation will come down.
Inflation will come down.
And all this tightening is already in the pipe.
Yeah, and the economy will slow more than the Fed forecast. Yeah. I have to say, Melissa, in all honesty, I didn't know the answer to the question that I asked Powell. I don't know what he can do here. And I think his answer was sort of, what's the way you say it? Sort of a play within a play. All he could do was talk tough and say, look, we may raise it again. We're going to go up to 5 and change. And if you look, by the way, at the conviction of the Federal Reserve, I was very impressed by this. I broke down the dot plots for you here. Take a look at how the 2023 projections they have here. 17 members are above 5% now in terms of the outlook for the Fed. None were in the last forecast. Well, there's that way to look at it. Guys, I gave you a better chart that's more understandable. But in any event, maybe you can glean from the dots. There you go. I think that's an easy way to understand it. 17 are to the right of that 5.13. And there's a good wing there. 7 are above 540. And as Karen was saying earlier, there's one person who's not only 563 for 2023, but 2024 and 2025. That one person, we don't know who that is. We're going to try to figure that out, of course, over time. Only 2 are, look at that rate right there at 490. That's where everybody kind of thought the Fed was going to. So there is conviction on the Federal Reserve of getting up to that level and staying there. By the way, that's the year-end forecast. That's not the peak rate forecast. That's the year-end forecast. So there's a lot of conviction there that that's what they have to do. They could all be wrong. That's entirely possible. But somewhere along the line, somebody's going to have to make a change here. Maybe it's the Fed. Maybe it's the market.
By the way, Steve, that chart, just you can't see it as well as we can. It looks like actually someone's giving you the finger. But anyway.
It's a Rorschach test, Tim.
It's okay. But higher, longer-term inflation in this country, and because labor is sticky, they've emphasized this. Housing costs may come down. Also leads to lower growth. Any just projection on U.S. economic growth at the next couple of years? This isn't a fair exercise for you, but higher inflation isn't good for stocks because ultimately we're going to get lower growth out of this economy.
I think that's right. And in fact, if you want to hear, Tim, the other question I was going to ask Powell, which obviously only get one question, is you notice how he said that labor shortage isn't going away anytime soon? Well, you know how you calculate growth, right? It's hours worked plus productivity. If productivity doesn't change and we have a permanent labor shortage or a secular labor problem in this country, that does mean lower growth for the long term as well. That's something else to think about. I think an environment of lower inflation is an easier environment in which for companies to operate, even though they have done quite well in this inflationary environment. They have, in fact, increased their margins. And so what's going to happen here now, Tim, worth also putting into your spreadsheets there, is as inflation comes down, margins should come down too. So you got to figure that out too.
Yep. Steve, thank you.
Pleasure.
Steve Leisman from Washington for us tonight. How will companies fare in this new environment, Guy? Higher for longer?
I think, listen, how much longer can you pass on your cost to the consumer?
They're reaching a limit
right?
at this
So when
point.
you hear
We've seen
PepsiCo
that.
or General Mills, 16% organic growth, which is just code for 16% inflation we're passing on to the customer. How much longer can, I don't think you can. So to answer your question, margins contract. I think revenues, by definition, start to contract, so earnings do as well, which means the multiple you pay for all that should be lower, too.
I think expenses contract. I think we're going to see a real white-collar recession, right? The number of job openings for blue-collar is still huge. They're nowhere close to filling that. And yet, on the other side, we see white-collar jobs cut every day, and we just getting started.
Yeah.
So that doesn't come out in hourly wages, but it is deflationary.
There's a psychological effect, too. If you see people at your company, right, getting laid off, and you're seeing belt tightening at your company, no more travel, no more dinners, no holiday party, et cetera, that gets you to belt tighten yourself in your own household. So there's like a ripple effect here. How do you think about that hitting white collar in particular and the impact on the economy?
Yeah, I think that, obviously there should be some trickle down from white collar down to blue collars, as white collar doesn't spend quite as much. That should trickle down. But I think Karen's absolutely right. I mean, when you look at the labor shortage, it is in the service industry. It typically is in blue collar jobs. The way I always say this is, if you're a hotel and you were able to staff to 80%, right, post-pandemic, and you lose 10% of your business, and now you're only 90% full, you don't have to cut, the staff around your hotel. And that's going to be a tough hurdle to climb.
All right.